From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Farrow. Bloomberg Real Yield starts right now. Coming up, U.S. inflation accelerating to a fresh 40-year high, pushing consumer sentiment to a record low, inverting the curve, keeping pressure on Chair Powell. We begin with the big issue, inflation in America.
The CPI report.
U.S. CPI index.
The headline number obviously came in hotter than expected.
What I would worry about is there's been a lot of people embracing the idea that, oh, this is the peak.
The risk here really is that inflation becomes unhinged even further than what we've already seen.
The reality here is everybody knows that inflation is not going to be transitory.
In the face of 5, 6, 7, 8% inflation, you still have a Fed funds rate that's under 1%.
So from the Fed's perspective, the Fed is still well behind the curve.
You have to bring at least up to, let's say, 3, 4, 5%.
The Fed has more work to do.
Yes, we're squarely in a slowdown.
We have made the turn on employment.
There's lots of bad news, and everybody knows what the bad news is.
This will do nothing to deter the Fed from where they're going.
The Fed will be raising rates, no chance of a pause.
Joining us now to discuss BlackRock's Jim Keenan and Lotfi Karoui of Goldman Sachs. Jim, I want to start with you of how much today's inflation read really highlights that perhaps things are getting a little bit less in control than the Fed would like to see.
I'm not sure. I'm not sure it changes the fact of what we're in right now. We're in a very tight market right now when it comes to inflation, meaning that the Fed is still dealing with the demand side of the equation based off of all the excess liquidity that was put in the system, and obviously the restart of the economy coming out of the pandemic. But the supply side part of things is just very, very tight, and there's a lot of volatility associated. There's a lot of uncertainty with regards to how those will open up. And so when you think of things about like goods inflation and labor, and you think about the global supply chain and issues with regards to the Chinese lockdowns, or you think about food inflation and the issues associated to the extended conflict between Russia and Ukraine, as well as oil, which is a huge thing, because even as you start to see demand continue to pick up, you're in a very tight market. And all three of those are subject to, I would call it downside risk, or meaning more upside risk to inflation because of how tight those markets are. And so that's a complex environment for our policy to try to navigate. And, we are in a period where they're trying to push down to a soft landing, but those variables are going to be very volatile over time. And so there's a risk of stagflation and there's a risk of recession, but we're certainly cycling down towards that.
Lotfi, do you think that this actually materially changes the prospect of some sort of recession, of a downturn, of a hard landing?
It certainly further deteriorates the trade-off between growth and inflation. I think we learned that with today's CPI print. The ECB acknowledged that yesterday on the back of the June meeting. But in general, this makes the policy backdrop even more challenging than it had been only a couple months ago. Now, a recession is not our baseline. At the end of the day, what the Fed is trying to do is twofold. One, reduce the pace of hiring in the job market. And then number two, cool down a little bit wage inflation. We do see a path for that, but obviously almost by design, that path is quite narrow. But at the moment, a recession is not our baseline forecast. In terms of where the Fed is going next, we think 3 50 basis point hikes, all the way till September is very likely. And then after that, it's still a long time. We'll learn a lot of new information and then we'll see what happens. But for now, 3 consecutive 50 basis point hikes and still no recession.
And you're not alone with that across the street, but your economist, Jan Hatzius, boosted his Fed rate hiking forecast on the back of this CPI report to exactly that, 350 basis point rate hike. Some, including Barclays, Jim, have talked about a 75 basis point rate hike at this meeting next week. Do you think that that's likely?
I don't think they'll shift just because of the communications that they've had to date and trying to maintain a level of getting control of this, but also credibility with regard to their message. I don't think it's out of the question that they should try to do that to try to get a better narrative in the overall market. But at the end of the day, this is going to play out over time. And I agree with Lotfi that in the sense that, there's a lot of opportunity for them to have and navigate a soft landing, but the markets are going to challenge it, right? And you are going to see a lot of volatility around risk premiums, just based off of every data point that we see or every language that's coming out of central banks around the world. And so I would expect to continue to see volatility around equity prices, the rate curve, as well as, spread product.
Why haven't we seen more volatility around spread product, Jim?
Well, I think you have in the last couple of months. I mean, it's a pretty significant move. There's a couple of things that are more fundamental and then some technicals associated to it. But, on the fundamental side, we're coming out of the last couple of years of a great earnings environment, right, where you had tremendous operational leverage and you had really good earnings. And so you had improving credit quality. I think on top of that, most companies on the levered credit space, were fairly disciplined when it comes to the structure of their balance sheets or how much leverage they were putting on. And so coming into 2020, you had a pretty healthy kind of public levered credit market, I would say, broadly speaking, the credit markets. A lot of that liquidity that pushed into the system when it comes to valuations reached into more of the growth equity market or in cryptocurrencies. So there's a fair amount of discipline as you start to see this evolution of policy tightening and then growth scare. You're now starting to see some more volatility on equity prices, broadly speaking, as well as some of the better spread product. And that impacts the technical side of things that you're seeing with fund flows and deleveraging.
Certainly today we saw a pretty big sell-off in the equity markets with NASDAQ leading the way down, more than down 3.6% at one point, has retraced a little bit of that. Lotfi, to that point, these positive aspects that have really supported credit valuations and capped some of the spreads, how wide they can potentially go. You have Deutsche Bank coming out, disagreeing with this and actually seeing the prospect of a credit default cycle, unlike what we have seen over the past decade, getting into 2024 on the heels of something that's more like a hard landing. What's your view on that?
Look, I think the question becomes whether you believe in the longevity of this business cycle or not. That is certainly debatable. But I would say from a credit standpoint, this is still a pretty young credit cycle. What gets the credit cycle to an inflection point where you see a big increase in defaults, negative rating migrations, is basically years of bad capital allocation and inefficiencies on balance sheet. The reality is this is year 2 of the expansion, full stop. And so I completely agree with Jim that going into the year, we already had a pretty strong survivorship bias in the high yield market. Corporate balance sheet credit quality is very good, although we think it probably peaked in the third or the fourth quarter. And so I do struggle to see a strong case for a meaningful uptick in defaults, even if you have a recession. I think, it will likely be the first recession where it is unlikely to see, high yield default rates go into the usual double-digit levels, which is what you've seen in the past 30 years. So that's a comment for the high yield bond market. I think for other parts of the leveraged finance universe, broadly syndicated leveraged loan market, or maybe private credit, things could be a bit different. But on the public side for bonds, I struggle to see a strong case for a meaningful uptick in defaults.
So, Lotfi, do you think that this is a good time to be buying credit, particularly the riskier side?
I think, look, there's a better value proposition from a yield standpoint. Spreads valuation have reset to okay levels, not great levels in my view, but everywhere you look in credit, you're sort of at the median of the last 20 to 30 years. I do think that there's more room to rebuild some premium here. The reason is quite simple. The tails are fat and macro vol is very high. And so even though we do believe that there's a path towards soft landing here, the reality is there's a wide range of outcomes, and markets don't operate on model outcomes. Markets operate on the full distribution, and right now that distribution is not looking very friendly towards risk appetite. And so what you need to see is evidence that that soft landing path is becoming tangible. It is materializing, and I think that process is probably a couple quarters from now.
Jim, before we move on, I really want to get your sense on how the glut of private debt has changed the equation for credit markets, including public markets. When things go south, you sell what you can, not necessarily what you want to, and there is a sea of less visible debt out there that people have been investing in that is illiquid, that cannot trade. How much could that potentially raise the selling in the public markets? Because that is what people can sell, not what they will sell in case of a downturn. How much does that raise a pressure for spreads that perhaps wasn't as present in previous cycles?
Yeah, and Liz, I don't necessarily think that's the right way to look at it. At the end of the day, credit has grown alongside GDP. There's certainly over the last decade been an evolution of the credit market as the ownership from banks across credit has really moved towards the public credit markets. Investment grade, high yield loans have all grown alongside that, but also the private credit markets have grown alongside the growth of private equity, right? And so I don't really look at it as a sense from a glut standpoint. Obviously, there's different risks and different profiles when you think about private credit, but at the end of the day, the majority of private credit is owned in lockup structures, either long-term evergreen strategies or in vintage funds, very similar to private equity. So if you are looking at a recession or defaults or losses seen in those, ultimately that will eat into the return profile of the fund that private credit manager is running. It doesn't necessarily force selling elsewhere. And it's not like what you've seen in some of the hedge funds that may have owned a lot of illiquid assets in a liquid vehicle, in which case, as you take those marks, you're forced to delever. It's a very different dynamic associated to that, and I would call that very healthy when I look at today. So at the end of the day, the credit cycle is going to be determined based off of the earnings cycle, right? And you think about, where we ultimately end up with economic growth, where we ultimately that leads to with regard to the earnings quality, that will feed through into the public and credit markets with what your longer term returns are. And I agree with Lotfi, there is value here. That being said, there's a lot of potential risks in the macro economy that are going to put pressure on what the level of earnings are going to be in 2023 and 2024. And that's where you're going to see across managers a wide range of dispersion between the quality of returns that we're going to be able to produce for our clients.
Jim Keenan, Lotfi, Karoui, both of you sticking with us. Up next, the auction block issuers rushing to market before going silent ahead of today's inflation print. That conversation coming up next as two-year yields in the U.S. hit the highest levels since 2008. This is Bloomberg. I'm Lisa Abramowicz in for Jonathan Farrow. This is Bloomberg Real Yield. Time now for the auction block, where we kick things off in Europe with a slow Friday capping off a busy week. A 48-hour debt binge taking weekly issuance above 31 billion euros. In the United States, high-grade bond sales topping $33 billion this week, the largest volume in nearly 2 months. And the junk bond market remaining steady after its busiest week since January. 6 new deals priced worth roughly $3 billion. Sticking with credit, Schwab's Liz Ann Saunders recommending investors stick with higher quality names. Take a listen.
It's not like everything else is hunky-dory and the economy is on fire and you're seeing a move up in spreads. We've got that double whammy of the recent move up in spreads at the same time that growth and demand are slowing. And that is going to start to be problematic for lower quality companies. The low quality trade, I think, is very much in the rearview mirror.
Joining us now, I'm pleased to say, Crossmark's Victoria Fernandez joining the conversation alongside Jim Keenan and Lotfi Karoui, who both are still with us. Victoria, let's start with you. This sense that there could be a haven in risk. Does that story disappear when you start getting some of the growth scares that you're seeing right now?
Yeah, well, I mean, Lisa, look, we always focus on the quality, right? And so investment grade is where our focus has been. We have a little bit of exposure to high yield, but not very much. And, you were having a conversation a moment ago about high yield and what spreads were doing there and default rates. And obviously, when growth slows down, some of those higher yield issuers are going to have trouble with their revenue, with their bottom line. And so you might see those default rates go up, and it makes them a little more risky. It's not an area that we think you should roll the dice in. I do agree with Liz Ann on that. I think you need to be very choosy and really focus on quality. Quality of the companies, quality of their balance sheets, quality of the earnings that Jim talked about a moment ago. Those are the areas where you need to focus. And unfortunately for high yield bonds, I don't think that's going to be where those items land, especially if you don't have coupons that are paying you for taking that risk. And we just don't have that right now.
Victoria, do you think the U.S. is still the sweet spot for investing in credit and beyond?
Yeah, we still like the U.S. right now. I mean, obviously, you see Europe having the issues with the Russia-Ukraine war, with food price inflation. We see China shutting down with Shanghai again this weekend. So there's continual issues going on there. I think in the U.S., the underlying fundamentals are still strong enough that it's probably going to outperform international this year, both equity and fixed income.
Right.
So we would stay domestically focused for now.
Lotfi, what's your sense in terms of the U.S. versus Europe, especially as the ECB does start to tighten, but raises the prospect of being flexible, of fragmentation and being sensitive to that in the periphery?
I agree with a preference for owning credit risk in the U.S. relative to Europe for really two reasons. One, downside risk to growth looms a lot larger in Europe relative to the U.S., particularly given the threat or the risk of a ban on natural gas. And then number two, this is a really key difference between the dollar market and the euro market. The euro market has been a lot more dependent on ECB support for many, many years. Just to give you an idea, the ECB owns over 11% of the overall investment-grade Euro IG market. They've bought over 50% of the year-to-date net supply in the Euro IG market. That's gone, basically, in the second half of the year. And so markets in Europe will essentially have to learn to fly without the ECB. And the fact that that support is being reduced at such a rapid pace is a reason, I think, to be overweight the dollar market relative to the euro market.
Jim, Barclays weighed in on the credit route following the ECB's latest rate decision, writing, quote, even if relative value has been tilting in the favor of Europe, it's undeniable that Europe remains the eye of the storm, agreeing with both Lotfi and Victoria. Jim, what's your view on how to look at European credit?
Yeah, I would agree with both of them. I mean, at the end of the day, when you kind of look at that in spread terms, you know, Europe looks attractive relative to the U.S. when it comes to the pickup in premium that you might be able to get in spread. But you also have to look at it as relative to the economy and those earnings. And Europe right now is prone to a lot more risks than the U.S. are just because of the input costs and more specifically gas, as Lotfi was talking about. And so, you know, that when you're thinking about margins in a company, you know, they are in Europe, they're much more exposed to getting squeezed as the consumer continues to weaken. And now the ECB is taking a much more hawkish tilt. And you have these input pressure costs that's driving kind of the squeeze in margins. And so I think even though the European market is probably a bit of higher quality when it comes to historically looking, but I think they're more exposed to earnings risk in the future, in which case you'll probably have some more spread volatility than the U.S.
Lotfi, are foreign investors still coming into the United States to buy credit? We saw this for Japan, for example, and there's been some speculation that's not going to happen because of where the yen is.
Yeah, it is a little bit complicated for foreign demand. But number one, I think, you know, the yen is a great example, but you've had significant depreciation year to date. All else equal, that sort of erodes purchasing power of Japanese investors. But more importantly, in our view, the economics from a funding and hedging standpoint in the dollar market has changed quite dramatically. If you walk in the shoes of a foreign investor, so a non-dollar denominated balance sheet, to deploy capital in the U.S., you basically have to fund and hedge a position. And that funding and hedging cost is going to go up over time. And so our expectation is that foreign demand will likely look a lot weaker, certainly relative to 2020 and even 2021. So the outlook is not boding well, in my view, for foreign demand.
Well, you're all sticking with us as we get to the final spread. Victoria Fernandez, Jim Keenan, and Lotfi Karoui. Still ahead is that final spread the week ahead, featuring a host of central bank rate decisions from around the world. So let's see what the Fed has to say about the CPI print. That conversation coming up next. I'm Lisa Abramowicz in for Jonathan Farrow. This is Bloomberg Real Yield. Time now for the final spread the week ahead. Coming up, U.S. PPI data coming on Tuesday, followed by initial jobless claims later in the week, plus a trifecta of central bank rate decisions, starting with the Fed and Chair Powell news conference on Wednesday. Then it's the Bank of England's turn on Thursday, and finally rounding out the week with the Bank of Japan on Friday. Still with us, we are so happy to say Victoria Fernandez, Jim Keenan, and Lotfi Karoui. Definitely a lot of noise around the Fed meeting in particular. Victoria, do you want to weigh in on how much they have to bring forward some of the rate hiking expectations as a result of today's inflation print?
Yeah, Lisa, I'm not sure they're going to do a lot based just on today's number alone. I mean, what is Powell and the rest of the Fed president's been saying? That they want to see clear evidence of things changing. They want to see it over time, not just one number. Obviously, the CPI being higher today, and not the headline, it's the month over month that's truly important, right? That's what they're watching. Not seeing that month over month number come down is going to be troubling for them, and especially because it's driven by rents, and rents is so sticky. So I'm not sure they pull forward this meeting. I'm not even sure they pull forward at the July meeting. I think it's September where people have to start wondering, what is that going to look like if we don't see inflation start to come down by then? It gives them a few more data points to make that decision. I think for the next two meetings, it's going to be what they've already told us, and that's 50 basis points at each one.
Jim, do you think that this is enough in order to recognize what we just saw just quickly here?
Well, I don't think it's enough immediately. I mean, combined with how the narrative might change within the Fed, certainly I think they've pivoted away from thinking about growth and they're just focused on getting inflation under control. So there's a lot of factors that have to walk into that. And I think, some of the information with regards to, the demand that we're seeing, consumer sentiment, but also, the jobs picture, you've already started to see some softening in that, some softening in the housing side of things. So it is starting to pick up, and I think they're going to be a little data dependent, but the market's going to, again, challenge it. And I think the risk premium will continue to be volatile in the short term.
Yeah.
And largely thinking, I think, the next couple of months, it's going to be volatile, but I think it will prevent or it will provide some good opportunities to invest in some assets here.
All right. Well, time now for the rapid fire round. 3 quick questions, 3 quick answers. The first one, Lotfi, I'll start with you. Is U.S. inflation becoming unmoored?
No.
Jim?
No.
Victoria?
No.
Are the chances of a U.S. recession in the next 12 months above or below 75%? Victoria?
Below.
Jim?
Below.
Lotfi?
Below.
All right. Will we see parity with the euro-dollar cross in the next 6 months? Jim?
Yes.
Victoria?
No.
Lotfi?
Tough one. No.
My thank you to all of you, Victoria Fernandez, Jim Keenan, and Lotfi Karoui, on this insane day as we rethink how high peak inflation really looks. From New York, that does it for us. Same time, same place next week. That was Bloomberg Real Yield. This is Bloomberg.